Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
It is that day of the week once again. It is Saturday, so if you were wondering, who knows if that madman from Europe is going to come in and bore us out for another hour plus once again, I'm here to say, yes, sir, you're goddamn right. Here we go for another weekly market recap. Now, the week was, obviously, as usual in this period, particularly volatile, especially in metals and cryptos. To some degree, the stock market as well, although, not comparable to the rest, obviously. But, there were a few things worth noticing. On the economic calendar side of things, what we can see, obviously, is that we didn't have any NFP or unemployment report because of the micro shutdown, which should be already resolved, as far as I know, because they reschedule the report for, next week, the 11th, I think. So, all things considered, it was short-lived. But, the other things coming out, ISM manufacturing PMI, which after a long time of being in contraction territory, aka below 50, finally spiked up above 50 for a little bit of an expansion. Now, let's have a look on a different scale, different perspective, if you wish, if it can deliver the message better, right? Now, what does it mean? Well, obviously, it's good news, right? Although, one should be more interested in the trend rather than a single spike because, you want to see these things sustained. But, it could be a start, right? We have been spending months saying that no matter the claims of the current administration, it was looking like nothing was working when it came down to kind of resolve the situation in the sector. And maybe, just maybe, we are starting to see the results. We'll see. Again, it will probably take another 6 to 9 months to actually see tangible results. But, you got to start somewhere, right? At the end of the day, even if you check the employment side of the survey, you see that, it went up a tiny bit, although in this case, still below 50. But, these things, they take time. So just keep on monitoring what's going on here. It could be the start of something good for America, all in all. Just remind yourself that as good as it might seem, right, be realistic. The way the American economy is structured, this is still just 30, 35% of the entire domestic economy, because the sector which is predominant, of course, as usual, is the service sector. So, not bad, but at the same time, don't expect that it's going to move the needle as much as, a huge variation in the services sector would do, right? But, still better than nothing, right? Moving on, we got the ADP employment change, and this one was bad. It came in at 2022, but overall, as you can see, it's been relatively flat and very, very near to the zero line, which means that we are not adding a lot of new jobs. So, and it's still, I think we are going to see what's going on with NFP next week. But whenever I look, I don't see anything really screaming that the labor market is improving. If anything, I personally am getting continuous confirmations of the opposite scenario. So it could be, something that, over time, it keep on deteriorating. And at a point, it just gives up. So, I think there is a lot of risk tied to it right now. But, we'll see. As many other things in macro, it takes time. Sometimes it's months, sometimes it's years. It's like, do you remember inflation, right? It's kind of the same talk, right? Inflation, it's never going to come back, or at least, it's never going to slow down. Well, yeah, sure. It took it like 2, maybe 3 years, but it went from 9+% back down to 2 point something percent, and probably it's going to slow down a bit more. Now the official data, of course, are 2.7, and we are going to have CPI next week. which oddly, I think it's going to be on Friday, if I'm not mistaken, but, what you're going to do. So, moving on, we got, oh, look at that, the ISM Services PMI, which is still very, quote unquote, strongly in expansion territory, well above 50. And, even in this case, if you look at the trend, right, if you want to call it that, I mean, it's not rosy. It's not like the economy, it's completely booming, but it's way better than the ISM manufacturing PMI. Let's say it just recovered a bit faster than that, and it stayed way more stable. Especially, it always stayed in a territory which is signaling expansion rather than contraction. So, all in all, good enough, I would say. If you dig into the report, there are mixed out results, especially, the worrying thing might be new orders, as you can see, which came down, and the employment side of the report, which came down. But, there are a few things which are good. Let's say, you see, for example, business activity, which improved. Then you see inventories, which went down. That's usually, good enough. And they were growing, right? So, I mean, at the end of the day, I think if you have less inventories, it means that, you are actually delivering what you need to deliver. I might say, we're talking services. I think that's something which applies more to the manufacturing side of things. But, at the end of the day, you don't want to see your inventories being stockpiled, because it means that you can't move things around. And usually when you can't move things around, it's because there is not enough demand, aka the economy is contracting. So, in isolation, the single report, it's not that bad at the end of the day. And if you see the aggregate total, it's confirming that it stayed flat, but it stayed flat at a relatively high level considering the period, right? Then moving on again, jobless claims, they spiked a little bit. I mean, it's not something crazy, but, they came up a tiny notch. The continuing jobless claims, kind of rangy for now. Was looking better. It was looking like it was rolling over, but it got this uptick right in here. So we'll see about this. This is not really something that I'm particularly worried about, because we've seen they can be, as a data point, it can be very noisy. And I don't, especially with the gig economy right now, I don't think it is really helpful to capture the correct state of the labor market. Just a quick talk, but there are many jobs that you can do now and you couldn't in the past. And maybe if you are performing those jobs, although they're not paying a lot to make ends meet, but they still prevent you to access the unemployment benefits. So maybe you don't get into the statistics in here, but at the same time, you're not making a hell of a lot of money to say that, your personal situation is booming, right? So, there is a little bit of contamination of the signal in that sense. And it's just, the sign of times at the end of the day, I guess. But, that's just my opinion. The 4 week average, of course, it was coming down, uptick a little bit, but, not a huge change, still coming down, lower highs, lower lows, right? If it was a chart. And then jobs openings, and this is one where I think, again, we are looking at deterioration in the labor market. Now, if you check, we are back to pre-pandemic levels when it comes down to the new jobs created. And again, I have another one to better, or maybe it exacerbates the scale a little bit. It makes it look a bit worse than what it really is. But at the end of the day, no matter the scale, the data is the data, whatever scale you wanna use on it. So that's another sign that something is clearly not going well in the labor market, right? And I think someone is starting to sniff it, right? Which is why you see a lot of volatility, and which is why the sentiment it's particularly low. As you can see, again, we had another, although this one was a preliminary one, Michigan Consumer Sentiment Survey. We are gonna have the final, I think, in 2 weeks, maybe, if the schedule is right. I could be mistaken, but anyway, it was a preliminary, it's not final. But as you can see, the trend, it's still the same. It's down, and 10 years, we are basically at the same lows we were at the end up to middle of 2022. So not super cool. What else? Well, we got the Challenger survey coming up, and 2 things about it. The hiring plans announced, as you can see, very low. Although, they have been particularly low over the last few years. Sporadical spikes to the upside, but, all in all, there is not a lot of hiring. I guess we are in that period where we got no hiring but no firing, and therefore, again, the labor market is just stagnant at the end of the day, which is really it's not what you want to see in an economy which is growing organically, but again, it's still better than plunging. So, pick your poison there once again. What's next? The job cuts still coming from the Challenger survey. And they came up a little bit, not a lot, but they came up. If you check over the last 10 years, as you can see, sure, throughout the pandemic, and then, another spike in 2025. I think that was on the tariff shock. So, this is the one you would like to see flat rather than the opposite, right? So what you're going to do, this is how things are for now. So let's move on to the break-evens, which, they are still going higher. Although you start to see the divergence in here, right? Just a little bit of an example. You see that usually when you have a divergence, at a point, both are going to converge to one direction. The latest example we had one in here, but it's too tiny. So let's have a look at one which is macroscopic, and you can really appreciate that. Look, this one right here. You see the 5-year, it really starts to run to the upside, but at the same time, the 10-year, it is actually slowing down and going into a contraction. And then, they both reverse, and at the end of the day, the 10 years is kind of right. It could be the same in here, right? You see that the spread in between the two is actually widening for now. So if we don't have any other signs of an inflation which could be sustained or a higher than normal inflation, I think even these two might come back down, and the divergence will be resolved in the favor of the blue line, aka the 10-year break-even inflation rate. We'll see. Obviously, too early to tell, but again, as usual, if you check the unofficial sources, BCE right now, the read is 1.35. CPI, let's wait for it, it's below 1%. Which again, if I don't know, because nobody knows the future, but if this turns out to be true at the very end of the day, and you're now looking at the BLS reported rate at 2.7, man, that is a huge spread. And if it works like it's working over time in the break-evens, if the spread will be resolved in the favor of the unofficial sources, strap on, because we're going to have something nasty coming, all right? GDP now was 4.2, so it came down a notch, but again, this is just for the sake of the estimates, but I'm not really putting a lot of weight on this one. We'll see. And at this point, I just want to know the full-on year data. Like, I'm tired of the quarterly estimates and then revisions. I want to see how 2025 was. I know I'm going to have to be patient a little bit more, but that's what I'm interested in, right? Fed Watch are pretty inconsequential now. And credit spreads, they had this tiny little bit of uptick in here, which is, of course, if you zoom out, even on a 5 years chart, nothing to be seen there. But just a hint of on what we may touch on later on. I think there was a little bit of a problem in the credit market. Now it's not picked up here, of course, because I feel like we're not really talking about the entirety of the credit market, but just a, let's call it, quote unquote, tiny niche of it. And, especially private credit. So nothing to do with, bonds, treasuries, or corporate debt, right? Nothing about it. Although, I do think a lot of corporate debt out there, it's too risky right now. And in my opinion, it will turn out. And again, could be 6 months, could be 1 year. It might turn out that is overvalued compared to what the real capacities of these people to pay down those debts actually are. So we'll see about that. But the problem was in the private market, credit market, and in that niche, which is actually financing new businesses, startups, and all the rest. Guess where? In the tech sector. But again, a little bit more on that later on. For now, let's close down the window on the economic calendar and the macro data points, and let's jump into the charts, shall we? So looking at these charts, let's start out, as usual, with the DXY. And as you can see, at the very end of the day, we had that tiny bit of a fake out to the downside. And now price just reclaimed this level. Which was what? Previous expected support, although we discussed how much would you expect from it right now. But anyway, it was a nice pivot for price action, as you can see, even in the past, all right? Now we're living above it. I'm talking about this level, 97, 200, something like it, right? Now, so the question becomes, was it a massive fake out to the downside? And now we're going to shoot back higher. Reality is, at least for me, obviously, so my assessment would be the best thing would be choppiness right now. Because we have seen a tiny bit of an attempt to expanding higher and then a huge expansion lower. So, would I expect now the market to completely go the other direction and just, shoot higher from here, kind of like in this fashion? Probably not. I mean, currencies, when currencies tend to have these spikes in volatility, they are more often than not, followed by a tiny, decent period of contraction, right? So, I think for now, there is a good chance we are going to be stuck in this range for a while. Could be a week, could be 2 weeks, but that would be my first scenario, so to speak. It is true that when you have huge defined range like these, when you have a fake out, the move, let's say this is your range low, this is your range high, you just faked out the lows. But usually after this mean reversion, the first target would be what? Well, the midpoint of the range, which would be, on a macro scale, kind of at this point right in here, which lines up with previous expected support, now broken. So a bearish retest in here, right, to confirm them as resistance now, potentially, which would fit with the narrative of faking out the lows, mean reverting to the midpoint of the range, right? But, this is why I'm saying maybe a little bit of a mean reversion and then choppiness, like maybe the first attempt would be a rejection, right? But, I do agree that if you look at that on a larger time scale, usually when you have these fake outs, eventually, right? It might take a while, but eventually you target the other side of the range, which would be this one. Coincidentally, there are very clear and defined highs in here. So, wouldn't be this area here at the very end of the day. It wouldn't be a bad area to be targeted later on. But again, we are getting a little bit ahead of ourselves. I think probably not going to happen next week. So in the very short term, I'm interested in looking at what's going to happen here. do we keep on extending this bounce, and how do we react if and when we do approach this area right in here? Or, the opposite scenario would be, are we just testing back into an old low in here, right? And therefore, we're going to see rejection here. We immediately lose this level back and start to roll over. And therefore, DXY keeps on plunging to the downside like that. So this is what I'm looking at. And again, for next week, at the very least, my base case would be a little bit of choppiness in this range. And, the invalidations for this scenario would be, as usual, getting back below the current reclaimed support, and that therefore continuation down, or breaking completely to the other direction and reclaiming this level right here and then keep on pushing higher, right? So that would be the DXY for me this week. Let's have a look at the others. Now, I got the other currency right now, but, briefly, Chinese yuan, nothing changed. South African rand saw a little bit of volatility this week, as you can see. And now I'm gonna, if you just look at this segment of price action, what does it remind you of? Because I know what I'm thinking of when I'm looking at this. I'm not gonna tell you up until later on, but there's kind of a topping pattern. I think I already seen it around. And you have too. But I'm gonna tell you later on, right? So, a little bit of volatility, but we just came back into this previous area of support right in here. We held it for now, but, now we are stuck into this level right here. So maybe, again, a little bit more of a choppiness, but I don't think the long-term trend is being invalidated for now. Russian ruble finally broke out of this dealing range. It is retesting it now. I don't know, I don't know the Russian ruble enough. I'm not confident enough in these, but naturally, what you wanted to see now would be something like this, a little bit of a choppiness, and then keep on climbing, right? Although, given how it behaved in the past, I wouldn't discard a bit more choppiness, even with a little bit of a farther pullback before staying stable in this, new range, like working off and creating a new dealing range, right? Or, maybe just a much more pronounced pullback, and then it should back higher again. But, I just, I keep it in here for the sake of completeness and because I had to fill the void, but I'm not really familiar on the Russian ruble dynamics, right? The Indian rupee, it had a huge bounce in here, right? Well, when I see stuff like that, I always think about a central bank intervention, but I didn't check because I wasn't home on a Friday, so I don't really know what went on. Although, if it was something like it would have been when? Over the weekend. Well, at that point, maybe I was drunk. This is why I don't know. All right. But, okay. Other than that, Brazilian real, which basically it just had a nice low in here. It was a very structured low to be put in, very ordered. It respected a lot of previous levels and finally broke out to the upside, retested this breakout area, and it looks like it's holding it for now. So, cool. Australian dollar, which was just going up and up and up. And no matter the huge mean reversion we have seen in the DXY, this one stayed particularly stable. Now, I do know that the RBA, so what was that? Anyway, the Australian Central Bank, Reserve Bank of Australia, that's what it is, right? They actually hiked the rates. 25 basis points increase on what? Inflation fears. So, well, although, I mean, they did it this week. And, the run-up was kind of like an anticipation of that, maybe. I don't know. again, I like to look at the Australian dollar, but do I follow Australian monetary policy so much? No, I don't. But that's what they did. So could we have a little bit of a sell the news event, right? And then price will try to draw back this inefficient leg. Maybe. Or, we are just going to, we just spiked, we accumulate a little bit, and then, rounded reaccumulation, and then we keep on going higher. I honestly don't know. There is not a lot in proximity of this price action to come up with something. Like, the most recent highs were in here, as you can see, back in 2024. So, for now, the only one thing would be this level right in here, hold the highs. Let's see how price behave around them. We can hold them and keep on pushing. Well, then it's good, right? Let's have a look at the majors. The euro, obviously, came back down, but kind of the same talk on a very different scale relative to the Aussie dollar. These old highs right in here, we are trying to hold them and maybe reaccumulate a little bit around them. Again, as for the DXY, I would expect a bit of choppiness, both in the euro and, the British pound. So, maybe even the Canadian dollar, right? As you've seen in the past, the loonie, huge run-ups, like in this case, and then a slow bleeding back to draw the leg back. Same right here, huge run-up. Could this be a slow bleeding, maybe another week of these, and then maybe shoot again higher again? I would say up until the point we can maintain, obviously, the structure intact, aka these lows, they hold, well, then you can be bullish the dollar Canadian, I guess. The Swiss franc, well, I guess, if anything, this is the one I would be a bit more bullish on, just because, I look at the trend and, over the past months, it's been kind of the strongest one. So I would keep on betting on the strongest, obviously. If I hadn't had anything better to rely upon, right? Now, look at the yen, right? The yen, it's basically back to the same levels where it was when we got that spike. And I know I do sound like a broken record, but, central bank interventions, right? How long do they last? Look, I'm not saying that it's going to break down immediately and keep on dropping to 160 or whatever. Look, fundamentally, I do think over time, this thing is going to go to 200, right? But it's not going to happen all in one day. But again, how many times have you heard me saying, look, there might be an intervention. It's going to last for what? A few days, a few weeks. But at the end of the day, market forces are way more powerful than a central bank. So it might be we are about to see another iteration of that. Now, look, a tiny parenthesis about Japan before we keep on going. So everyone is saying that, the yen should have gone higher because yields in Japan were going higher. Maybe not, in a sense that yields might go higher, but I don't think, as I said many, many times, that at the end of the day, the decisive factor for a currency is essentially and solely tied to the interest rates differential, right? I think yields are more tied to economic activity or risk aversion or risk-taking, willingness, whatever, not necessarily to the currency. I think the yields differentially can play a role if a lot of the other factors are kind of in line with each other, but I don't think you can just look at the yields differential in between, I don't know, Japan and the US, Japan and Europe, Japan and the British Kingdom and saying, yeah, well, that's it. That explains everything. I think there is a bit more to it than just that. And speaking of Japan, now everyone is saying, well, so yields will go up, therefore they're going to be fucked. Maybe this is Japan last array, or maybe Japan it's just normalizing itself. After 30 years, after 2 decades lost when it comes down to growth, wage growth, and all the rest, maybe they're trying to normalize themselves, right? And this is what I mean. Let's have a look at these charts. So obviously, this is what everyone is looking at, the yields going up, all right? Okay, so you got the 10, the 5, and the 2s, all right. They are basically lifting the pedal from the metal when it comes down to yield curve control, QE, infinity, and all the rest. They're letting yields floating where the market would want them to be, all right? And what does it mean? Well, for the first year, time in 20, 30 years, they actually got a decent inflation push, right? I mean, you can look at 2014, 2008, maybe, or 2007, should I say. But, those were just spikes, right? This time around, since 2021, basically, inflation went up. And then, instead of being a blip and a spike and coming back down immediately, we are looking at a sustained period where inflation stayed relatively higher compared to the previous years. All right. And what? So you have two now. You got inflation, yields, and when you adjust yields for inflation, so you look at inflation adjusted, so real yields, what you see is that at the end of the day, they are not so high, all things considered, right? So they are just getting back in line toward levels which are much closer to what the CPI is doing. Okay, so when it comes down to that talk about yields differential, right? Although, what you see, it's basically the opposite. In Japan, yields are going up versus the US, well, where yields are actually, stabilizing, staying flat, if not, especially if you look at the short end, coming down a tiny, tiny bit. You see that, you got Japan in blue here. It just looks like they are kind of getting back in line with where the US are, right? And again, is it good? Is it bad? I'm not saying it is necessarily bad or good. I'm just saying it's getting back to a much, quote unquote, normal situation. Because what wasn't normal is having a country where interest rates are kept artificially at or near zero for 20 years, right? So, I think they are normalizing. And then now you got yields, you got inflation, and then you have GDP. Look at what GDP did. Now, sure, again, we're talking about lost decades. So basically from the 90s up to what? The 2015s, GDP, there was no growth in Japan. Especially if 90s, 2010s, right? Those are 20 years, right? No growth, absolutely. Stagnation. And now, especially after 2020, yeah, we got the major scare, but look at GDP now. So again, you might look at the yen and saying, well, the currency is fucked because the country is fucked. But at the end of the day, what's really happening is there is inflation, yields are going up, getting back in line with the current rate of inflation and GDP, so we got economic growth. Yields are a reflection of what? Inflation expectations and economic growth. So Japan is just getting back to normal at the very end of the day. Will it be enough to offset the 20, 25 years of fuckery that we've seen there? Too early to tell, in my view, but, nonetheless, it's worth noticing. And you know who else noticed that? The Japanese stock market. Again, it peaked in what, 88, 87, somewhere in here. And then, it just pulled back for what? It looks with 20, 30 years, right? It just changed the trend to the upside in 2015, and it went up ever since. And we finally broke out of the all-time highs printed at the end of the 80s. So, something it is actually changing there. Now, sure, you could say, well, the stock market is going higher because, if it is true for America, why not for Japan? QE, money printing, and all the rest. I wouldn't challenge you on that, right? Asset prices, inflation driven by an expansion of the monetary base because of the central bank. Okay, I get it. All right, fine. But, there is another thing about Japan, which when you look at, it makes it a little bit less fucked, right? I'm not saying rosy, but less fucked compared to what you may think. And that would be this one. Debt to GDP in Japan, it came down from basically 240 down to 200 and what? 30 right now? So, yeah, sure. It is still massively high, but, at least it's slowing down. And again, what does it tell you? It tells you that, there is a little bit of my own personal opinion component in it, but it tells you that no matter how you want to try to spin it, the current system, and again, you might like it, you might not like it. I'm not here to tell you what you should like. I'm just saying how the system is designed. It is based on debt. All right. And the only way you have to maintain the system and to make it sustainable is to keep on growing. So the way out of debt, it's not paying the debt down, right? In an ideal world, that would be it. In this one, it's not. The only way out is to outgrow the debt. So as you can see, their debt, it kept on going higher. They kept on issuing JGBs, obviously. But, since GDP went like these recently, right? This ratio went down. So there was more growth compared to the new debt taken on. Right? So that's the only one thing you could do. And even, if you want to run a parallel, if you think about what the US did after World War II, they had a lot of debt, right? What did they do? Did they completely pay down the debt? No. But they grew so fast that it didn't matter if the debt was growing because they were growing 2 times that. Random numbers, but you get the gist of it. And again, now we're looking at many countries of the Western civilization and, people calling for austerity, people calling for this and that. And look, it could work. Obviously, if you go into austerity and you do fuck all and you don't spend any other thing, sure, the debt is going to be under control at the expense of everything else, basically society. And again, you might say that's the right or the ethic or the moral thing to do. Just bear in mind when you take these type of decisions, real people are going to be involved. Their education, the labor market, the healthcare system, everything. So it's not something that you should take lightly, like saying, well, you know what, we're going to pay down the debt. We're going to cut all the government spending. And again, I know I don't like government spending because I think it's massively inefficient, but you got to have some. Or at least if you want to rein it in, it cannot be overnight. So instead, instead of being inefficient and unproductive debt, what if we start to use the debt the way it is intended to be used and start doing productive investments which going to pay themselves over time so that we can outgrow the debt that we are contracting in order to finance those expansions, investments, and improvements, right? That would be a nice thing to do. Unfortunately, what you would need is someone with a functional brain in the driving seat taking the decisions. I don't think we got them now. At least not in Europe, sadly, right? So, ending up the parallel, see the dichotomy in here, right? Japan is full of debt, sure. But contrary to, let's say, the US, they don't have a lot of foreign investors. Now, you might say, well, sure, obviously, who would want to invest in Japan, especially after you show that they didn't grow for like 20 years? Sure, that's right. But it is also true that if you own all of your liabilities, you're not at the mercy of the open market or the rest of the world. While instead, what's one of the main themes going around right now? Sell America, right? So to some degree, it cuts both ways. Being exposed to foreign capitals, it's good when they are coming in. It might also be bad if they all at once they go away, right? So Japan doesn't have that problem. And even if you look at the account balance, look at that. No matter they were not growing, at the end of the day, it's always been way better than what it was in the US, because of course the US has a margin deficit, trade deficit, and all the rest. I think, I get it. I get Bloomberg right here, but I think, this one, it's kind of like comparing apples to oranges, because the US, again, we get back to the same talks about this is how the system is structured. The US, under the current system, unless they decide to try and change it, they cannot have a surplus. Or at least it would be very difficult to allow them to have a surplus, and at the same time, the rest of the system to keep on functioning. Because what you need in a system which is massively leveraged on what? Dollars, aka debt, contracted and denominated in dollars. What you need is dollars they need to keep on flowing. And who's the only one which has the printing press for dollars? It's the US government, right? So they need to keep on buying more from the outside, so importing goods and services in and sending dollars out, which will keep on, fueling the machine of debt. Because when that mechanism stops, what you're going to have? A dollar shortage and a wave of defaults on all those US denominated obligations and liabilities which were taken on. And now you don't have the flows of dollars to rolling them over, paying them down, and all the rest. So, that was an interesting case on Japan at the very end of the day. Now, I know, a little bit of a long section, but nonetheless, was interesting in my view. Especially, because of what? Well, because everyone, when they look at the yen, they keep on thinking about the yen carry trade blowing. I think, though that might be a risk, probably not now. Because again, given what we've seen, in order to maintain that type of dynamics, what do you think is going to be the exhausting valve? The currency. So, at the end of the day, I'm not, on a macro time scale, I'm not expecting the yen to go up. Probably for the next 5-10 years, right? Unless, again, something in the system drastically changes. But, up until that point, don't think so. Let's have a look at oil, which was pretty range bound this week. Last week, we reclaimed this level. We tested in this one to the upside, although it wasn't a real level. It was just a segment of previous price action where we had a swing failure pattern, but it played nonetheless. So, oil, nothing to say about it. I mean, just ranged for this week. I didn't hear anything new on the Middle East side of things. If not, talks, negotiations, and all the rest. So for now, I think even the price of oil, it's just a testimony that there is not a further escalation, but at the same time, not huge improvements on the side of negotiations, right? I'm on one side, I'm sorry to end up at the oil chapter so fast, but obviously it didn't do anything. So, up until the point we develop some sort of an interesting structure inside this range right in here, or we break either way. Let's say, we break to the upside, or we break to the downside and we get back into the old range right in here, I really don't have anything to say about it. Let's just wait and see, right? I mean, it was pretty volatile in recent weeks, so a little bit of a contraction, it wouldn't be terrible. Kind of like what we have in here. If you think back, this was Monday and this was Friday. So for an entire week, it just stayed range bound. That could happen, right? Now, strap on for the next one because we're gonna look at something which was painful throughout the week. All right, it's time for the Bitcoin chart. I don't know how to frame it because it moved so much that well, I mean, for those remembering, last week it was in here, and when I was recording my latest video, I remember I didn't do it because I forgot at the end of the day, but you know, Bitcoin was basically hovering around this low. That was that Saturday candle, right? It was hovering around here, and I was like, before the end of the video, I should get back to it to see if it already took out the lows. Yeah, it did, right? It did, and it kept on drifting down basically all the week. So, I mean, yeah, well, is there anything relevant to say for now? I would say, look, as soon as we broke this level, which, by the way, if you scroll back, would be this low right here, this pocket of liquidity which originated and formed the lows before the run up. So obviously we reacted a little bit in the wrong way, in the sense that we pushed through and then we used it as resistance, as a ceiling, in order to keep on drifting lower. There was another tiny bounce in this area, very short-lived, previous highs essentially. And finally, after a huge candle on Thursday, that was what, a 10K candle, I think, from 73 down to 62, almost 62, a 10K candle. We're back to the good old days of Bitcoin with those huge ranges, even from one day to the next. And it looks like now we bounced off of, I mean, look, there was this one, right? But, you know, overall, this was some sort of a base, but inside of it, you could identify these other level right here to the downside. But I mean, going farther south, well, I mean, a tiny bit here, but I think all in all, the area was here, this level, and overall, this consolidation in here, that's what provided the bounce. So now the question becomes, we came down something like 40% since mid-January, so 3 weeks, give or take. Can we finally put together a decent bounce? And again, my statement, my assessment would be it is a bit early to tell, unless you zoom in and you look at the lower time frames, right? So first of all, it would be nice to reclaim this area, right? I mean, at this point, we start out with the usual spiel about, well, I mean, it was expected support, it was broken, so now up until the point we at least reclaim that, there's nothing to be bullish about. True, all right? So, you know, you would need to reclaim a few levels of support or building up a new base in here. So maybe, you know, it would fit the Bitcoin usual behavior. Like we have a huge move and then we spend what, like maybe a month or two going nowhere, consolidating, something like it. So, I mean, it would be nice, you know, if we could just build up a decent low, maybe retesting around the lows, coming back up, showing that we don't want any further continuation. And at that point, breaking out, you know, and starting to run. I think a complex low would be better in here, you know, for the long term, obviously. If you're just playing it to say, I think there was, if you look at the futures, yeah, there's a gap in here. So unless you are basically trying to play it for the gap fill to the upside, you know, I don't think a V shape would be super cool. It's one of those things. Recently, what we've seen is that no more very pronounced V shapes and very complex bottoms and tops. So it's moving more and more like a traditional asset rather than a shitcoin. Although, if you hold it and you see it coming down 40% in 3 weeks, you might still call it a shitcoin to some degree. Now, I've seen we had, I don't remember if it was a Thursday or maybe yesterday, Friday, MicroStrategy earnings reports and talks. And look, I mean, let's put it this way. At this stage, I don't think MicroStrategy or strategy, whatever, it's going to be out of business, let's say tomorrow or next month, next 6 months. No. I do think they're not in a very good situation, obviously, but, this is not me saying, well, Michael Saylor, you shouldn't listen to him because he's going to be out of business in 2 weeks. No, I'm just saying that I found particularly stupid, if you allow me the term, to say stuff like, well, it doesn't matter, it came down 40%, but for those which are in for the long term, you have to embrace volatility. Volatility is a gift. Is it? Is it a gift? I mean, maybe. Like, the shit came down from the highs already 50%. That's a decent haircut. Now, you might say it is a gift, and I get it. I know what you're trying to say. I know what type of cult you're trying to build up, hodl and all that bullshit. But, if you are on the wrong side of these 50% haircut, volatility is not a gift, it's a curse. It's easy for him to say, well, hold it, at a point it's going to go up. Yeah, sure. And and then what? That's the most stupid thing I've ever heard. And I know why he's saying it. I mean, it's just a pitch to his own company and all the rest. But it is just fucking stupid for the average guy. So, I mean, if you have any stake in anything, it could be Bitcoin, it could be gold, it could be silver, it could be bonds, it could be the stock market. Don't listen to these clowns saying that you need to hold no matter what. You are gifted. You need to have faith in the long term. Look, you need to turn off the TV and really starting to grow up hair, right? That's what you need, instead of listening to these ballers and clowns on the internet telling you what you should do with your money, especially because without your money, they wouldn't be shit. Think about Saylor's business model. He's doing a lot of things without putting in anything. It is all debt, which, strangely enough, it's why his stock is down 80%. It is all a massive leverage play and a financial engineering type of operation. And when it unwinds, well, this is how it ends. Now, again, I'm not saying he's going to be out of business, especially, it is all a matter of matching assets and liabilities and assets and liabilities durations, right? So, I'm going to say that I don't know deeply and profoundly all of the different preferred and convertible bonds that he issued. But, just in principle, right? If those expirations are way farther ahead into the future, right? He got time. So that's my point. I think the first one, it's 2028, maybe. Plus, there are different, caveats that a few bonds could be called in sooner rather than later. I mean, he's not a stupid man, right? When it comes down to, building up his own financial engineering and making money for himself, it is stupid to listen to him when he tells you to hold to something which is going down like that. But that's a different, can you understand the two different layer of the conversation here? Because that's what you get with crypto enthusiasts more often than not. It's a very tribal world. I know because I've been there, right? But, you need to split the two things. So I don't think he's going to go out of business because he still have a bit of margin of error right there. Now, sure, his stocks might be punished, all right? Especially, as we see markets, they do move on expectations more often than not. So if the general feeling is going to be that the company's not going to be able to pay, the dividends, the preferred, the coupons and all the rest, well, sure, maybe at that point you might see a MicroStrategy going down. And the problem I see with that, and again, I'm not saying it's going to happen today or tomorrow, but the potential risk that I see in that is that, in order to entice people to actually buy the convertibles, or, there is this mechanism, right? So if the price goes down more than a specific percent, right? Rather than the conversion rate that is, stated in the original contract, the convertible bond, well, then you're going to have what? Instead of a 9% dividend yield, we are going to increase it to 10% in order to match up the deterioration in the price of the underlying asset. Yeah, but that just means that you're going to pay out more to people. And since you're doing it with debt, that would mean that you would need to take on even more debt to pay down the existing debt, which you are, increasing the burden of it in order to keep people invested and not being forced to liquidate your assets if capitals start to actually flow out. I mean, it can work for a while, but is it sustainable? I would say at the very least, it is very risky. And the point is that maybe Michael Saylor is not going to be out of business, but a lot of other companies which started to perform the same type of operations on, crypto treasuries companies, which started out on the same business model because they saw Michael Saylor's one actually performing particularly well. They started later. Maybe they started when price was a bit higher. Therefore, they're already way more underwater than Michael Saylor would be. And they would need to do what? To liquidate their holdings in order to pay down their liabilities. And there might be that which brought to a sharp decline like this. So who knows, right? Again, on the technical side, all I would say is that we need to keep on reclaiming a few levels, first and foremost, or build up a decent low. On a macro scale, at the end of the day, if you remove a bit of drawings, we are just bouncing off an area which was a long-term accumulation area. So is it Bitcoin completely obliterated, fucked? No, obviously not. I mean, it's here to stay. Whether, in 10 years, it's going to be there. Whether it's trading at 40K or at, 500K, but it's going to be there nonetheless. At this point, it's another one of those things where the genie's out of the bottle. You're not going to put it back in, right? So after that, let's have a look at gold, first and foremost. So gold, at the end of the day, again, it held support, although pretty much volatile because of what? Well, because of the huge amount of leveraged positions which needed to be liquidated, all right? But at the end of the day, it held, low, which is not even a lower low on a daily time frame, bounce, another push down, and good bounce on a Friday. So not bad. That was good. I mean, look, throughout the week, sadly, I don't have the layout put on anymore. But, anyway, we were bouncing off, right? I was particularly interested in this area because not only it was the previous shelf top, which obviously didn't hold on the way down. So I was expecting a little bit of a support and resistance flip type of dynamic there. It was matching up with a few high volumes node on the volume profile. And I used one which I drew from here to the top, and another one, it was from, here to the top. I might retrieve the screenshot if I have it, but I was talking about it basically when price was here, right? I was like, well, it could be a dead cow bounce at the end of the day because, you know, these area could provide a good chunk of resistance. But I guess, you know, we will need to assess whether we can create a higher low or not. And by the look of it, it looks for now, at least we are trying to work on a higher low to be put in and potentially continuation higher. I think you gotta be particularly nimble with gold right now and just look at the past. Now, you take this segment of price action, and I know it's particularly volatile, but let's, does it change a thing if I go on a logarithmic type of scale? No, changes nothing. So let's get back to the regular one. But look, let's put it this way. So you see what's going on here. Massive run up, volatility, sharp decline, reaccumulation. At least, you know, what it looks currently like accumulation. Because obviously, if you see something like it, at that point, it's redistribution, all right? But what I would try to think of instead of, you know, pulling my hair and saying, yeah, this is over. It might be over. Yeah, sure, it could, right? Especially on this volatility. But looking at the past, right? See this pattern right here. And then what? Sharp drop, bounce. Again, tiny consolidation and reaccumulation. Is it similar to what we got, I don't know, here? Let's just remove this segment of the chart so that you don't have any type of prejudice, so to speak, right? Look at that. Good run up, volatile, draw back, or draw down, or pull back, whatever. Then we bounce, consolidation, a little bit of a down move again, reaccumulation up. Oh, look at that. Huge run up, and this was going on for a long, long time, right? Huge run up, spike in volatility, market collapses, and even in this case, it was what, from peak to trough at the very end of the day, almost 12%. So not a lot like this one, but the current one, but nonetheless, goes down. It, you know, on a macro, you know, not macro, on a much longer time frame scale, it puts together a bounce, sold off at the previous top or around it, works off a higher low, it keeps on reaccumulating, and eventually it goes up and up and up. So again, it might take a bit of time, but if you want to be bullish or if you want to keep on being bullish, I would say just wait it out. In the sense that if you somehow manage to survive the volatility, I would say at this point, the kind of like the scary part should be over, so to speak. So unless you don't see something like it, and then we break and we come drifting down, at that point, yeah, top. It is definitely a top now, right? It has all the characteristics of a top. But in the meantime, you know, let's just wait for what is going to happen here. Because if it ends up like the previous iterations, it might be we are still on the way up. The best thing scenario for me, it would be kind of like the rest of the month of February going nowhere. Or, you know, let's say the next 2 or 3 weeks, right? If you account for the fact there are 5 trading days every week, that would be another 15 candles, right? Going like this, essentially. If I wanted to be bullish, I would like to see something like it. Not an immediate and quick moonshot again, and obviously not a farther pullback. But that would be what I would like, right? And, you know, other than that, I don't think there is anything more to say about gold. Let's have a look at the other metals. Look, briefly, that South African rand type of chart, I was talking about the resemblance with silver, basically, right? So now, let's have a look at these metals. Do you remember I was saying, look, I think and that was like last week alone, I think. And I was like, look, having to think about it, I would put more odds on gold. Not only to be the first to, let's say, resume the uptrend if we ever have a resumption of the uptrend. But even, in maintaining a little bit more of its value in a downtrend, right? And we were talked about the silver to gold ratio and all the rest. And lo and behold, if you check metals like silver and platinum or palladium, what you see is that instead of having that higher low as gold had, they had a lower high. A lower low, right? Both in here relative to here, here relative to here. Although it might be minor, but there it is. Palladium didn't have it on an absolute term, but on a closing base, yeah, it did. So, tiny nuances there, but if you look at it like this, right, on a closing base, it had it. So, clearly gold is holding up relatively better compared to the rest. Although, again, copper among these four is the one holding up better. I think, for good reasons. And I know the narrative for, the supply squeeze on silver, and there's not enough silver. Sure, I agree, right? If we keep on using it the way you're using it now, probably there is not enough. But the problem is that when I see these spikes, I always start to wonder how much of that it is just fundamental fair pricing or just pure fever of speculation. And, it doesn't mean that it's not going to keep on climbing in the coming months. I just think we needed a good washout. And so far, since, again, as I said many, many times, I do live more in the short term. I wouldn't buy it, right? I wouldn't buy it in here. If I still had it, I wouldn't add to it. Look, conceptually, you want to add to things which are showing strength. So let's say you got silver from a long, long time ago, maybe from when it was around 30. Now, if you really keep on believing in the long-term thesis and you want to add to positions, is it safe to do it now, or would be safer to wait for something like this? Breaking a high, coming back down, holding, and making a new high after that. Now, at that point, you might say, well, yeah, sure. Okay, now I can add to my positions. Obviously, as every other time, when you wait for confirmations, you are sacrificing, there is a trade-off there. You are sacrificing more price-generated informations with better prices, essentially. So you can't have it both ways. Either you buy at these potentially hugely advantageous prices, but then you don't know what's going to happen on Monday. Could be, oh, well, yeah, that was another lower high, and we keep on drifting down, right? I bought here, I thought it was a good dip, I wasn't. So, either you buy at advantageous prices, risking something like it, or you wait for the confirmation, but then instead of buying at, 75, 78, you would have to buy at 95. Again, in the long term, right? If you do believe, it's the same as Bitcoin to some degree. If you think over time, right, silver will be at 200, 300, whatever you, does it really make a hell of a lot of difference buying at 78 or buying at 95? All in all, to me, it wouldn't. It's same with Bitcoin. Like, if you think it's going to hit 1 million, as Sailor says, in 10 years, well, you should be there. You should be out there buying it. Like there is no tomorrow. This is a gift, right? So, it depends on your disposition, on your risk appetite. I wouldn't, but, there are many other people in these markets, right? Let's have a look at yields. Now, obviously, on the back of what happened on Thursday with that huge volatility in Bitcoin, the stock market, and the data coming out of the labor market, yields, they plummeted a little bit. And again, we've seen a little bit of steepener, because the short end went down a lot, but not as much as the long end. So another steepener would be, all right. I think, at the end of the day, nothing really changed. And most likely we should start looking at the yields on a monthly time scale, because, looking at them on a week by week basis doesn't really change a lot. So we had what, essentially? People are calling it now the Walsh effect, the Walsh nominee effect. No, I don't think so. Right? No. Especially because, maybe he's a bit more hawkish, but at the end of the day, he was there in 2008, and he was voting in favor of QE and bailing out the banks and all the rest. So it is as hawkish as it could be up until the point some real shit hits the fan. And at that point, you would see it doing whatever the fuck his predecessors did. So, I don't think the market it's really looking at it through those lenses. Maybe initially the knee-jerk reaction, maybe a few days, a week or two, maybe, but I don't think that's what's really driving yields and bonds. I think it's more about what they look at from the fundamental side of things. And so, probably those data coming out for the labor market, or ADP, and the Challenger report, and then what's the other one? The JOLTS, right? And then on Friday, probably a little bit of a sell-off, pullback, because, well, not going to have NFP, so not another market mover to propel this move further, and it just kept on staying in this range, right? So I think there is not a lot to look at in the bond market for now. Even if you check the move index for basic bonds volatility, it's basically on the floor right now. We need some fundamental catalyst, I think. And, to some degree, if I had to bet, I think these things, they're going to go up. I would like to be a buy. Actually, I was recently, but the short end of the curve. But I just need a catalyst. Like, I do think the technical setup is there. I think the fundamentals over a long enough period of time are there. We need a catalyst, all right? I don't know what it might be, when it could be, but usually you need something to spark things out, right? So after that, let's have a brief pause, because I'm talking from basically an hour ago, and I need to drink a glass of water, and then I'll be back with the stock market, and we are going to end up the video. So let's briefly have a look at the charts. Monday was all up, both on ES, NQ, the Dow, everything was up. Then, of course, Tuesday, but pattern, immediately back down to base once again. So this time, what we've seen is the same behavior of the entirety of the previous week happening in 2 days. So, mean reversion. I gotta love it. And then we kept on drifting down on Wednesday, and when the US markets, they opened up, and they were particularly bearish once again. And same on Thursday, although, we had a little bit of a stabilization on Thursday in the latest part of the session. It kept on drifting lower on Friday, right? Well, actually, no, I take that back. I misread the times. We had a stabilization, yeah, but it kept on plunging in the latest part of the session, right? And then the big bounce on a Friday, which started out in Asia, and then it kept on going in London, and it kept on going in the US session. So all in all, the market is like that. And again, what we see is a little bit of a decoupling in between the Dow, which is making new highs, whether you believe it or not, on the back of what? You remember at the beginning of the video that ISM manufacturing PMI, right? So, people are piling in on the back of even, good data, right? The Russell, relatively stable, all things considered. Basically, it closed slightly above of the weekly open. The S&P just went out for a huge deviation below these lows, and then immediately Friday was a very good day. I mean, that's a bullish engulfing, right? Because we traded below the previous low of Thursday, and we traded and closed above the previous highs. So could be a very good bullish engulfing, although you would need to have continuation sooner rather than later at this point. And, these 7,000 level has been an issue for a long time now. We've been rejected twice at those levels. So maybe that's what we needed. Right? We needed to create a major scare to engineer a good amount of liquidity and, lower the bags for new all-time highs. Who knows? Although, the counter to it would be the tech sector not doing well at all. Now, sure, overall, if you zoom out, it's still in this range consolidation. It's been in here basically since October. And it's not really going anywhere. We finally had that look above and fail. We tried to push above these highs. We failed immediately. Down below. Another attempt, rejected immediately. Down we went. So my thesis has always been that it's hard to have a huge and sustained rally in the S&P if you don't have the NASDAQ sustaining it. Because whether you like it or not, the big caps are actually in the NASDAQ. So, even if the rest of the market is performing all right, the Max 7, the tech sector, the semiconductors, the mega caps underperforming, it would hold the rest of the index overall back a little bit, in my view. So, I would like to see new all-time highs on the S&P while the NASDAQ is actually following through. Which, I'm not saying it's going to happen. Again, I don't know the future. Nobody knows. But there is an interesting case to be built up. Now, but before we keep on going, talking about the weakness in the tech sector, we might have a look at these, right? Which ties in with what I was talking about in that niche of the private credit market. Did you know about BTCs, right? So, just for the sake of it, instead of listening to me talking for another 10 minutes, I asked Grok to define it. So you can just read the definition if you wish. I think, the latest part of this, it's kind of nice. But as of recent data, the BTC sector manages hundreds of billions, sure, reflecting the growth of private credit as banks retreat from riskier lending. I wonder why are they retreating? Right? So, that's why I say, well, private debt, it might be good. And sure, it would yield you more of a normal bond, right? Because the risk is higher, right? There is much more leverage involved in it. And, the thing with that is that when capital starts to leave the space, it's going to cause very sharp and sudden pullbacks. And the problem I see is that a lot of these investment vehicles has been used to fund what? On the back of the AI narrative, AI is going to eat the world. Well, have a look at something like Blue Owl Capital, right? For those following the space, you might have seen what went on in between. I guess it was Blue Owl and I think Oracle was involved. Oracle actually took a big hit because not only they said they didn't have the cash flow anymore to sustain their own expansion and investment plans, they were going into debt. And at that point, well, not only that, because it looks like even these companies which are throwing billions at, tech sector industries are now retreating a little bit, or at least the investors in them are retreating a little bit, as you can see from the chart. And so maybe we're gonna have to do it with our own equity, aka issuing new shares. How are you gonna do that? But anyway, you see the distress in the space, right? So that's what I was hinting at when I was talking about a niche of the credit market being in distress a tiny notch. And people are starting to notice that. As you can see, the amount of tech loans in distress is reaching into levels which you didn't see since basically the 2022 bear market, well, mini bear market, so to speak. All right. So, that could be a thing, another risk components that you shouldn't overlook, right? Especially, look at the outflows out of these, they call it redemptions. So look at the redemptions out of these credit funds. And of course, Blue Owl, it's one of the biggest ones, especially in Q4, but really it started in Q3. And again, check the chart. The peak was when? It was in May? June, beginning of June, basically. So, from there, you see huge amount of a drawback matching up with this one, right? Now, other than that, what else? Overall, I think same as last week, although the Qs might be a bit weaker, they tested back toward the 200 days moving average, and not looking good overall, gotta say that. But the rest of the market as a whole, if you check the benchmark, it's basically going nowhere. So again, rotations. I think at the end of the day, same as I said last week, rotations up until the point you can maintain them, at a higher level, ranging behavior, but at a higher level after a huge expansion to the upside, still good enough. Although from a moving averages standpoint, are we in danger of generating a very nasty cross? These yellow and these green are about to pinch themselves, so that could be a bad signal. Although, again, we started to diverge from moving averages a while back because the market was just chopping around. So, the efficacy of the signal might be depleted. So I think it's better to wait for a new and well-defined trend to emerge before getting back to rely a lot on moving averages. But nonetheless, it would be still a signal. One which, again, I wouldn't put a lot on weight on. Maybe I'm wrong. Who knows? But, that would be it. Let's just have a look. I'm not sure if I want to talk about... sure, we could look at the different sectors, but then, overall, there is another thing I want to discuss since we just touched on this rotation thing, right? Now, let's have a look at these for a second. So these, for those which don't know the acronyms, this is basically the software space, right? So that's an ETF which tracks the software. It is called SaaS, SaaS, which is those industries and companies which are selling or dealing in software as, I just forgot the acronym, software as a service or something like that. But, you get the gist of it. But you see that we have a very sharp drop. We are touching back into the 200-day simple moving average, which in the past actually provided good bounces, right? And, other than this, you might say, well, so we are approaching decent levels of oversold conditions. Well, okay, right? Now, and then if you keep on looking at that, you see that the software sector, right, if you measure the forward P ratio, they declined like a lot. So again, the market might be technically oversold. We had a huge contraction in the PE, right? Is it a buy? Is it a buying opportunity? The major scare there is that basically with AI coming on, a lot of what the core business of this company is it could be taken away. So they don't have a lot of defensive mechanism against this AI advent, right? So basically their business model is going to be outdated maybe in a few years. But, when things happen so fast, I'm always a bit skeptical, and I think there might be opportunity. All right. And look, this is what I'm talking about. Let's have a look at these, for instance. These are the mega cap growth ETF, right? So, if you do know the old debate in between growth versus value, when you think growth, think about the tech sector. Think about the NASDAQ, right? When you think about value, could be what? Your Walmart, Berkshire Hathaway, your Procter and Gamble's, or, these type of things. Although I've seen Walmart actually was moved into the NASDAQ, but yeah, I mean, you just, to reference a few names and to highlight the difference in between the two categories in, growth and value. So you see that now growth, kind of like the software space, it's at a decent level of oversold conditions, testing back into a moving average, the 200 simple moving average, which, last time we were trading around it, it was around the lows after the Liberation Day, right? Now, usually you tend to have this continuous rotation in between value and growth. And if you check back my videos, although I think you're never going to do that, but at the end of 2025, one of the things I said when we were kind of trying to forecast what 2026 could be, beside volatility and all the rest, there was a specific segment where I was talking about something like Staples. If you check Staples and what they're doing right now, right? Same with energy, right? Yeah, I mean, oil, it's bearish now, but somewhere in the next year, what was out of favor for the vast majority of 2025, maybe it's going to see a little bit of appreciation if the market actually rotate. They can rotate on a week-by-week basis, but even on a monthly scale, on a yearly scale, and all the rest, right? Why am I talking about rotations? Because there is something very funny which happens if you can nail these rotations, right? So still maintaining these parallel in between mega cap growth and value stocks, just have a look at these. So you see values, you see mega caps, right? Over time, they go up kind of in lockstep. Yeah, sure, there are periods where there are divergences in between them, but overall, they kind of move together. Recently, not so much, but, if you zoom out back in 2018, 2019, 20, it was kind of the same up until recent years. Now, why is this interesting? Because if you look at their relative performances compared to the index, so the S&P, what you see is this. You see that when you compare them to the aggregate market, right? They look like the mirror of each other, the specular mirror of each other. So there is an inverse relationship in here. Now, it's easy to say, well, so what do you do? Every single time you reach an extreme, you just rotate your entire portfolio from value to growth or vice versa. Up until the point you can nail those switching, or those turning points, those swing points is all well and good. Easy to say, right? But you don't have to nail the absolute top or bottom, right? You can still use it as a measure of risk And as a measure of convenience, when it comes down to how you rebalance your portfolio, it's kind of the good old theme, right? When things are massively overbought and overvalued, and I'm just looking at the orange line right here, right now, right? And on the other side of the spectrum, you got things that are massively out of favor, undervalued, oversold. Wouldn't be bad to trim the positions which are massively in profits and use those profits to buy back in something which has been out of favor for a long, long time, right? With a caveat that you would need to have, first of all, a fundamental reason. Secondly, you would need to seek technical signals for a reversion in either of the two. And then you would need a catalyst for something like this to happen. But again, even if you think back about oil being up or staples, right? Obviously, we didn't know when, we didn't know why, we didn't know that it would have happened that day, that week, but we knew that the chance was there. So at that point, once you have something that you see coming, what you need to do is just paying attention and starting to move your portfolio structure accordingly as these turning points actually unfold themselves. And if you manage to, I think, again, you can't be perfect in markets, but if you manage to grasp at least half of these rotations, right, over time, what you see is that you would be ahead of the market, right? Because you see that the orange line is what you would have by just holding spine, right? And, the blue, it's if you were holding the value stocks, which overall they underperformed, sure. The dotted black, it's if you held the mega caps, which overperformed a lot, and then what? And, they took a massive hit. So if instead you were being nimble and dynamic, and you were following these dynamics playing out, you could have captured, again, not all, but maybe a little bit of the green line right here. So, even if it's not all, it's still better than simply buying and hold the S&P, for instance, right? So there are periods out there where it's convenient to pay attention to these dynamics, right? Now then what? There is this usual, sell America theme. Everyone is deleveraging from America, ditching American stocks, American sectors, the US dollar denominated assets. Okay. In fact, what you see is that we just scored one of the highest on record inflows in emerging markets. So again, think about the same type of dynamic. Sell America. America is done. Nobody trusts them anymore. All right. European stock exchanges are at their all-time highs. Everyone is piling in the emerging markets now. Isn't it a good setup for a rotation to come up somewhere in 2026? And again, it could be in 2 weeks, could be in 3 months. I don't know. I'm just saying, paying attention to these things, right? Especially, again, because if you check, the underperforming behavior of the US equity market, it's usually very short-lived. And then it immediately goes back into overperforming. So, if you're holding a lot of international type of things, we've been looking at the Nikkei, sure, at a point, I think that would be a good opportunity to switch back to US denominated assets, right? Plus, although we have been looking at the fact that February is not historically a good month for the S&P in general, but we still have the narrative of the first month of the year to sustain a bullish thesis for the rest of the year in the US stock market. Now, again, just because it is a bullish thesis, it doesn't mean that you're going to have guaranteed double-digit returns, right? It could be just 1%. relative to where the market opened at the beginning of the year, but still, it would be positive. So you got that effect in between the first 5 days of January and the month of January as a whole. So when the month of January closes up, there is a very good chance that the year is going to close positive. And this is the average return, right? Now, 87%, because this is just considering the month of January as a whole, if you add in the first 5 days of January, so basically the first trading week of the year, and that's up more than 1%, and the month of January closes positively, this percentage, this win rate, right, goes up to 94%. So, you know, an additional 7 percentage points. Again, we're talking about closing positively, right? Not necessarily getting to the average. It could be slightly above it, slightly below it. This is why it is an average, right? But if you think about the S&P, let's have a look at this one. Maybe it's better. Where did we open this year, right? We opened in here, basically. So, you know, if that stat, once again, turn out to be true, from year to year end, where would a 12%, with the average, be? 770s. I'd say it is below average a little bit. Maybe just 9%. 750. So again, you know that I don't trust a lot the projections, especially when they are pulled up and brought up by banks. Like, you know, everyone has his own, like Goldman, JP Morgan. But, you know, that is kind of the range that these guys are estimating. 7,500, 7,700. Those numbers, they do actually come up a lot. The caveat, though, the caveat might be, you don't know what's going to happen from here to year end. What do I mean by it? Need a white chart, right? Let's have a look at the S&P. Now, maybe, right, eventually, this is going to be right. And we're going to end the year, I don't know, somewhere in here, right? Okay. But as we've seen, just the other, last year, basically, that doesn't tell you that you're not going to have something like this. So maybe, you know, a little bit of a drawback, a huge correction in markets throughout the year. And then we push higher. So, you know, volatility is always a factor to be considered. I mean, shit, look what happened last year, right? Massive drop, and then we closed the year higher. Could it be the same this year? Maybe. I mean, there are many different catalysts which would bring in a lot of vol, so just pay attention to it. So all in all, to rein things in a bit, I'm still particularly neutral on the market as a whole, with the caveat that, again, IQ a little bit weaker, so probably limited upside for now. The Dow and the Russell, I keep on having a little bit of hesitation in calling these rallies sustainable over a long enough period of time, up until the point we don't see macroeconomics data sustaining these theses. Like, again, you know, the ISM manufacturing being massively up this time around, but what if it's just a blip, right? We would need a bit more to confirm it. So all in all, I would say navigate these markets with a lot of caution for now, and just be aware that volatility is always there. So, you know, weeks like these or days like these, as we've seen recently on the major indices, they're not out of the cards yet. So just pay attention to it, right? With that said, I'm going to wish you a very good rest of your weekend and a very good start of your next week. And as usual, be nice and be cool. Neil's out.
Let me tell you something. There is no nobility in poverty. I have been a rich man and I have been a poor man, and I choose rich every fucking time. Because at least as a rich man, when I have to face my problems, I show up in the back of a limo wearing a $2,000 suit and a $40,000 gold fucking watch. Fat boys, duke it out. Hit him. Get the fuck off of me. Now, if anyone here thinks I'm superficial or materialistic, go get a job at fucking McDonald's, because that's where you fucking belong.